Stock futures are ready to rally here. We got calm in bonds after some overnight selling has eased back. Jim Bianco joins us, president at Bianco Research, for a look at the macro here on an earnings-heavy week. Jim, what role is the bond market going to play after a couple weeks of pretty intense selling?
I think it's going to, unfortunately, continue to play that story. The bond market right now yields have been going up. It's been selling off because the economic data has been pretty good. It's been beating expectations. It's been showing an economy that it's very resilient. And now we're getting into a period where we can't really rely on the economic data probably until the end of the year because of all the hurricanes. Friday's payroll report is going to be almost impossible to read. You know, the estimates are all over the lot. Some people think there's going to be a big weather effect in it and have negative payroll numbers. Others think there's going to be no net weather effect, and they're near 200,000 on the number. So it's going to be very difficult to discern the true trajectory of the economy a week before the Fed meeting. The issue that the Fed has to face right now is that 50 basis point cut they did on September 18th. The 50 itself wasn't the mistake. It was the signaling that we're going to start with 50. And as Austin Goolsbee, the Chicago Fed president, said a couple of days after the meeting, they've got hundreds of basis points to go in order to get back to neutral. And I think the market is rejecting that idea that if you're going to cut that much, you're going to overstimulate the economy and produce inflation again. And that's why I think you've seen what has arguably been the biggest rise in yields after the first cut in at least 40 years, that we've seen the 10-year yield go up 60 basis points in the following month.
That's a fun fact. It's, I guess, a better problem to have than the alternative. Is that a fair way to think about it, Jim?
It is and it isn't. It's a better to have as the alternative in that, you know, for the stock market, because what the stock market sees out of this is earnings and growth. And that's why it's been responding positively. But there's a point there with the stock market that, you know, higher yields become serious competition for the investment dollar. That's something we hadn't had to deal with in the last 20 years. But now with these yields at these levels, people are looking at bonds as a legitimate alternative to the stock market. And it's a good problem to have, except this is a K-shaped economy. So on the top end of the economy, you've got people that own homes, that have assets, that have higher incomes. It's good for them. But people on fixed incomes or don't have assets or don't own a home, and they're subject to the cumulative 20% increase of inflation. And if this produces more inflation, they could be net losers on it. So this is why you can have both an economy that looks good and seems to be going forward in the stock market responding to it. Yet in the political polls, everybody thinks that the economy is terrible. And the reason they think it's terrible is for half the country to try and absorb that 20% increase in prices has been very painful for them. And anything that we do that would produce more inflation would really hit them in even worse than they've already got it.
I don't want to get too out into left field, but is there also possibility that half those people who report feeling like crap are doing it because they're so highly politically polarized? Like last week's sentiment, we saw numbers for like Republican respondent satisfaction go way up around the same time as some of the betting markets went up for Trump. So I wonder how much of that economic reporting, self-reporting, is reflecting a little political anxieties.
Oh, no, I think there is a lot to that, you know, and we're going to find out because as we see, you know, let's call it what it is, that the data, like the consumer confidence data and stuff, is showing Republicans gaining, enthusiasm because they think Trump's going to win. Well, let's see what happens in 9 days when we have the election and we get the results. Hopefully we get the results soon thereafter. And then we'll see if there's a giant shift in the data. Assuming Trump wins, does Democrat enthusiasm plunge and Republican enthusiasm soar? Or if Harris wins, do we get the opposite? So, yeah, I think there is some of that. But I also think that a lot of that is driven at the lower end of the scale. It's not necessarily driven at the higher end of the scale.
Fair enough. Okay, so then to come back also to the alternatives, the bond market, which was bull steepening into the Fed cut, looked a lot more like a traditional in-cycle situation. But to your point about the rise in yields after, the bear steepening here, does that potentially also support some of the notion of economic stability for that lower end to keep their jobs a little longer? Because when we were doing that bull steepening, that was kind of like the classic way that cycle ends. The Fed cuts and they have to keep cutting. So a stair-step pattern probably going to be a preferable one, I would think.
Yeah, the bull steepening, is the way. You're right. That's the way we always uninvert the curve. And the reason that we do that is that usually the Fed, which they did in September, starts aggressively cutting interest rates because they get very worried about the economy. And that's why short rates fall through long rates, and then you get a positive yield curve. But then right after that, it just stopped and it started going the other way. And we've seen a more of a bear steepening with rising rates, with long-term rates rising faster. So that's why I think that this has been a very unusual pattern. As far as the lower end, yeah, I mean, the strong economy says, your job is not at risk, but at a 4.1% unemployment rate, I don't think a lot of them were worried about their job. What they're worried about is the prices at the grocery store. That's what's really hurting them. And I'm talking about the cumulative rise in prices since the end of COVID that they're still trying to catch up with. And that's where I think a lot of that discontent you see comes from.
Okay. And then this kind of brings us back to the brass tacks question of, what level or rate of change for rates matters. Because to your point, it's been a pretty sharp rate of change since the Fed cut and, a sort of an anomalous timing around the Fed cut. But at 4.2, we're still below the year high, which is like 4.6, close to 4.7, which is below the 2023 high of straight 5%. So take me through kind of the trajectory you think is possible here, Jim, and which levels become pain points.
Yeah, so the current level of the 10-year yield is almost exactly 50% of the way back from the 3.6% low that we had the day before the Fed meeting, and as you pointed out, 4.7% high. So we're almost exactly at the midpoint of the year, and I think that this is kind of the line in the sand that if yields keep going higher from here, that you would probably start to see it bother the stock market. In fact, you could argue it somewhat did, because the stock market has been stalling in the last couple of weeks or so, just as we've hit about this 4.2% level. And the reason for that is, what should the stock market return to an investor? And I'll quote Dr. Jeremy Siegel from his book, Stocks from the Long Run, and that, he looks at the inverse of the Shiller PE, and that's a fancy way of saying that you should expect about a 7 or 8% return in the stock market going forward. Now, I know most people think that you mean a quarter, right? Because that's the way that the stock market has been roaring ahead by 20-25% a year. But he says 7 or 8% is what you should expect going forward. Well, if the bond market, if you include corporate bonds in there, can yield you somewhere in the high 4s or 5s, you're looking at the majority of the stock market's gains with a lot less of the risk of the stock market. And for somebody, a boomer that's over the age of 60, that looks like, and boomers over the age of 60 have most of the money, that looks like an attractive alternative. Why take the thrill ride in the stock market when I can get most of its gains with a lot less of its risk? That's something, as I pointed out earlier, we haven't had to deal with that for 20 years, because for the previous 20 years, yields were down around zero. They couldn't compete with stocks. That's why we yelled the word TINA. There was no alternative. Everybody had to get into out of bonds and into stocks. But now there is an alternative, and it is the bond market. And that's why it shouldn't be a surprise that already this year, flows into bond funds have set a record. And we still have 2 months to go for the rest of the year, because people are looking at a 4.5-5% yield. And then they're looking at the stock market, the valuations, and they're saying, thank you very much. I'll take some of those bonds and then sleep at night and get most of the gains with a fraction of the risk.
Okay. A fun argument that kind of comes back to us now after we thought maybe that it was, going to the wayside here the last 8 months. Certainly brings it back into the table. So I like exploring it. Hey, Jim, give me a quick 30-second thought on next week real quick. If there's a big enough margin of victory either way, should VIX be somewhere closer to the teens?
Yes, but you're assuming in the question that we're going to know next week who actually won the election. I think the sooner we know who won the election, the better. But if you look at the bond market move, which is the VIX of the bond market, it is expecting a thrill ride next week. And the VIX, as you pointed out, is braced for some serious volatility next week over the uncertainty of who wins the election.
All right, great stuff. Thanks, Jim. Appreciate you as always.
Thank you.